In terms of the portfolio positioning, there are other areas of the market that we are attracted to that are trading at a discount to the broader S&P 500, and healthcare and industrials are where we continue to find some really attractive opportunities.
Hello from Frankfurt am Main. We are here today at the Fund View Roundtable talking about US equities, and with me is Anita Patel from Capital Group. Hello.
Hi.
What's your outlook for this year? Are you still generally positive for US equities, or what's kind of a key for your allocation in this upcoming year?
We remain quite constructive on the US for a number of reasons. And the three main reasons are that it continues to remain a core part of many investors' portfolios. The second is around the resilient economic backdrop. And thirdly is around robust earnings growth. So if we break down those three factors in a bit more detail, the US has developed a formula that has enabled it to deliver long-term equity market success, but also economic success. And it comes down to some parts of US exceptionalism around links to academia, deep liquid capital markets, innovation, and a lesser regulated environment compared to other areas of the world. The second is around the resiliency of the economy. We expect the US economy to grow between 1.5 to 2, maybe slightly more percent in the coming year. And it would be helped by tailwinds that we're seeing from the AI CapEx spending, but also some of the fiscal policies such as the One Big Beautiful Bill, which will which has the potential to create upside surprises to the economy, notwithstanding the productivity growth that we expect from artificial intelligence. And then thirdly, it's around corporate earnings. Whilst in other areas of the global equity markets, multiple expansion has driven equity market returns, for the US, corporate earnings still continues to be a good driver of returns. And so when you combine all these three factors, it really makes sense to consider an active approach to US equities, where you're able to uncover those long-term winners, access the breadth of the investment opportunities, and not just stay focused on the Mag 7.
You've mentioned the Mag 7. Everyone is kind of allocated in them. The big indices have a huge allocation in the Mag 7 and AI generally. How does your strategy differs from the big indices?
So Investment Company of America looks quite different from the index. We are underweight the tech sector and we're underweight the Magnificent Seven. However, I will like to point out that the Mag 7, these 7 companies are phenomenal, great management teams, generate a lot of cash, very profitable. So we shouldn't really compare those 7 companies. They're all very different, driven by different models, business models and factors. And the benefit of being active is you can pick and choose companies that you like based on their long-term fundamentals. In terms of the portfolio positioning, there are other areas of the market that we are attracted to that are trading at a discount to the broader S&P 500. And healthcare and industrials are where we continue to find some really attractive opportunities.
Are those sectors where you are kind of heavily weighted at the moment, because a lot of investors are thinking about being more defensive because valuations are high? The possible AI bubble is a big talking point. So how is your allocation look like at the moment?
We continue to maintain an active, core and diversified portfolio, especially when it comes to the US market. Over the last couple of years, we've seen a variety of style backdrops within the US, value, growth, and the shifts have been quite frequent. And therefore, it's really important that investors focus on company fundamentals, but also maintain a diversified portfolio so that they are able to navigate those style shifts and achieve a smoother pattern of returns rather than being focused on growthier or value areas of the market.
Thank you very much for your insights.
Thank you.